It is frankly hard to overstate the sheer scale of HDFC Bank within the broader Indian financial system. As the country's most trusted private lender, it absorbed India's leading housing finance company in a 2023 merger, expanding its physical footprint to nearly 10,000 branches nationwide. But a well-run, highly profitable institution can still be a frustrating place to park your money. We have to separate the underlying quality of the business from the immediate returns of the stock. If we plot HDFC on this quadrant chart comparing business fundamentals against current stock momentum, you'll see the problem. It scores exceptionally high on quality, but currently sits much lower on immediate market attractiveness. Buying shares of an excellent bank at the wrong point in its business cycle, or with mismatched expectations, can lead to years of underperformance. To understand exactly where HDFC is right now, we need to look at their full-year FY26 results. The headline number is clear. Profit after tax reached 74,670 crore rupees, delivering a healthy 10.9% year-on-year growth. However, that double-digit profit growth is acting as a curtain. Behind it, the bank is currently undergoing a massive, highly complex internal restructuring to properly digest the 2023 merger. We need to dissect these FY26 numbers to figure out if HDFC is currently a value trap tying up your capital or an opportunity for the patient, long-term investor. The answer to that question entirely depends on which of two specific investor profiles you fit into. Judging this bank by its surface-level profit numbers is a mistake. We have to look at the very specific structural trade-offs management is making on the balance sheet today. This bar chart shows the immediate aftermath of the HDFC Limited merger. The bank was left with a dangerously high loan-to-deposit ratio. They had too many loans on the books relative to the deposits they held, a structural risk that required an urgent fix. Throughout FY26, management aggressively prioritized deposit gathering. They successfully pushed total deposits up 14.4%, intentionally forcing it to outpace their loan growth, which they kept at 12%. Attracting that volume of deposits in a highly competitive banking market has a direct input cost. HDFC was forced to offer higher interest rates to bring those customers through the door. Paying more for those deposits created a severe negative trade-off. It compressed their net interest margin down to 3.38%. Because the margin shrank, the bank's overall net interest income growth slowed to 4.9%. Management saw the numbers and actively chose long-term balance sheet safety over delivering short-term explosive profit margins to the market. That defensive mindset carried over to their lending strategy. In FY26, HDFC deliberately slowed retail loan growth, capping it at a very conservative 6.5%. They shifted their capital elsewhere. Business banking and lending to micro, small, and medium enterprises rapidly surged by 20%. Avoiding aggressive retail lending has a distinct benefit. It perfectly shields the bank from widespread consumer defaults. This caution resulted in a net NPA ratio of just 0.4%. But safety requires a financial sacrifice. Retail loans typically offer much higher yields. By avoiding them, the bank capped its return on equity at 14.1%. While 14.1% is a solid return for most standard businesses, it sits significantly below HDFC Bank's historical pre-merger averages. HDFC is operating purely on defense. They're prioritizing stability in a potentially slowing economy, rather than chasing high-yield, high-risk growth metrics. You also have to carefully factor in the massive structural advantage HDFC gained by absorbing HDFC Limited's housing loan portfolio. They now control a vast segment of the domestic mortgage market. The strategy here is cross-selling. They can offer savings accounts, credit cards, and personal loans directly to this mortgage base, and vice versa. When you expand that massive ecosystem to perfectly include their sister companies like HDFC Life, Asset Management, and Ergo Insurance, they've created a closed-loop financial universe for the consumer. The main trade-off is that executing a cross-selling strategy across tens of millions of consumer accounts is incredibly complex. The financial synergy from this ecosystem will take years to fully reflect in quarterly earnings reports. The true financial payoff of this scale is heavily backloaded. It is going to test the patience of anyone looking for quick returns this quarter. Let's map this with a decision tree, starting with your investment goal. If you're a growth investor seeking rapid capital appreciation, HDFC will frustrate you. You need expanding margins, but HDFC is logging just 4.9% income growth and a suppressed 14.1% return on equity. While HDFC repairs its balance sheet and integrates systems, private sector competitors like ICICI Bank currently offer better immediate operational efficiency and market momentum. Short-term growth investors should deploy their capital elsewhere until HDFC's margins structurally recover from the merger. Resetting our tree, consider the conservative value investor. If your priority is compounding capital safely over 5 to 10 years, HDFC offers fortress-like metrics. They hold a massive 19.7% capital adequacy ratio and a low 1.15% gross MPA. Because the market is punishing the stock for its current margin pressure, the valuation is suppressed. This gives you a rare margin of safety entry point to buy into a dominant premium asset at a discount. If you can wait out the friction of the merger integration, HDFC provides direct, large-scale exposure to the long-term growth of credit across India. Ultimately, HDFC Bank remains a highly profitable, structurally sound institution. But it is currently trapped in a transitional balance sheet repair phase. A great company is only a great investment when its current strategic phase aligns with your specific portfolio goals. As always, study the latest quarterly results. Evaluate your personal risk tolerance, and consult a registered investment advisor before making any final decisions. The best investments don't come from finding a flawless company. They come from understanding exactly which trade-offs you are willing to accept.